Do you think that that is, this new cross-border investment, is that the new normal for these kind of REITs? Or is it simply just a reaction to decreased opportunity here in the States?
It's a little bit of both. I mean, if you look at the mall industry, it's very securitized. In other words, most of the malls in the US are already owned by the major mall REITs. So it is a little bit of being pushed out to look at opportunities. But I really do believe that there is an opportunity, a select opportunity for those companies that do have that specialized skill set and know-how. And I think you're going to see more of it. It's been a steady theme that's really been going on for more than a decade, and I think it's going to continue.
Good, okay. Are there any asset classes you think have a better outlook in one country more than another, and which ones would those be?
Yeah, so from a country basis, I actually really like Europe right now. It's one of the only places, frankly, in the real estate securities world that has any value left. Asia was really cheap, and that has repriced very aggressively over the last 6 months. And Europe is the one place where you can get some pretty hefty discounts to net asset value. You're talking 10-15% discounts to true underlying real estate value for obvious reasons. There's a lot of doom and gloom around Europe, but as a securities investor, you have to view that sometimes as an opportunity. And if you're investing in the right kinds of companies, so retail mall landlords with long-term leases, fully let buildings, very little development, and decent balance sheets, and you can pick these up at 15-20% discounts versus the US REITs at slight premiums. To me, that's pretty good investing. In the US, we like the non-prime types of real estate, if I can generalize. What's happened this cycle is that for the last 4 or 5 years, the capital has really stayed in the major markets in very prime assets, and it's bid the value of those assets up very aggressively, and it's pushed cap rates right down. And that's quite normal coming out of a downturn. But what's different this time is how long it's lasted and how extreme the pricing differential has gotten between prime and non-prime and more secondary areas. But now that's changing. As the economy does start to broaden out a bit, you get greater credit availability, and frankly, as the housing market starts to put in a bottom nationally, that's helping broaden that recovery, and we see much better opportunities, much better pricing, and a much quicker improvement in the fundamentals in some of these more secondary markets. So the apartments in the Sun Belt, shopping centers, and those are the kind of assets we're looking at here in the US.
Got it. Very interesting. Okay. I guess last